Hi, so tuning into Countdown, my name is Neeraj Shah, and the equity will talk, of course, the closing trades for the next 1 hour, 20 minutes. It's not looking all that great though for the markets. We are down about 0.5% trading in and around the lowest point of the day. The Bank Nifty 2 trading circa that lowest point that it has traded at today, 226 odd points. That's been the biggest drag in the session, and the market breadth as well as the volumes will tell you a story. Remember, today the volumes will be high. This is of course, the mid caps and the small caps, and evidently so that the market breadth is terrible in the session today. Okay, terrible may be an overstatement, but not looking good. Close to 1:3 or slightly over 1:3 in favor of the declines. And the volumes I was talking about, the cash market volumes are still low, so you don't have cash market participation, but the F&O volumes significantly high, even though it's the F&O expiry, the weekly options expiry day. I reckon that with these kind of volumes, we'll easily cross the 20 lakh crore mark by the end of close. But well, we'll talk about that when it happens. Bring up the heat map and just show you what's moving and what's not. Yes Bank is at the bottom of the heap, that I'm sure of. It's down about 12.5. But look at the cuts that have come into a lot of other names. It's not too often that we're seeing the next 4 names having cuts nearly 4%. ONGC, Tata Motors, Titan and Coal India, all of them down 4% apiece. Maruti is down 2.5%, Bajaj Auto 2%, Axis Bank about a couple of percentage points. It's looking very wobbly for the large caps. What's in just the handful of stocks which are gaining, and you can see there's a bit of management here. HDFC is doing 2.5% and giving that bit of weighted support to the index. Wipro about 3.5%. Aside of that, not too much which is holding out. HDFC Bank about 1%. So clearly a drift towards the HDFC twins to an extent. Infosys helping whatever little it can to the index, but otherwise it's terrible market breadth, more so at the broader end of the spectrum, Devina.
Yeah, in fact, the mid-cap index, Neeraj, is down more than 1%. In fact, closer to 1.5%. We're losing out on the broader market space, the mid-cap index. And you've got a sea of red across the board. I'm going to start off first. We're taking you through the losers, and then we move northwards to see what has gained. Mindtree, on the back of those really disappointing numbers this quarter, is down about 7.5%. You've got Graphite India, HEG, both amongst the bigger losers. Remember, they both tend to move in tandem, and over the last few sessions, they've not been really having a good ride. Aside from that, Bharat Electronics down 5%. Gainers, then, we'll quickly shift focus. Dish TV continues to gain some lost ground, inching its way towards about 34, 35. You've got Sun Pharma Advanced Research. Ever since the Morgan Stanley upgrade on Sun Pharma had come about a few days ago, Sun Pharma Advanced Research has really propped up in trade. Real estate as a pocket is doing well. Oberoi Realty stacking up about 3% higher. Indian Hotels, Godrej Industries, and then you've got a Coromandel International, which looks well placed in today's session, 1% higher. Within the small cap space, just quickly run through some names there about CG Power, that's up about 10% in the session. Following that, Canfin Homes, DCB Bank makes a comeback. So after that big thrashing that it received post numbers, the stock is finally seeing some amount of loss ground getting covered, 1.8% higher. Dr. Lal Path Labs is up about 1.5%. Just Dial is up 1.5%. Losers, Jet Airways, start was positive, and it's right now down about at lower circuit. Equitas is doing well. Smaller finance banks and Rajivan yesterday saw gains, so profit taking coming back into today's session. I just want to quickly highlight Colgate. The numbers came out just a few hours ago, and pretty much flat in terms of what the street was expecting and what it delivered. So that's why you've seen this big, there was an anticipation of a big volume drop, which didn't happen. They had the volumes grow by 4%, expectations was 4 to 5%, and therefore the stock actually moved up and now is plateaued around about these levels, 3.5% higher. But that's about the broader market space, what's been happening in the more liquid universe, the futures and options space, considering today is the weekly options expiry. Navneet is going to highlight that for us. Navneet.
Thanks for that, Davina. Nothing much happening, at least on the futures side. We've not seen any major build-up coming in for either Nifty or for the Bank Nifty futures. As we speak, Nifty futures from trading at a discount yesterday is just about trading flat and just 4% higher when it comes to OI build-up. For Bank Nifty, which is slipped below its 50-day moving average in today's trade, it's trading somewhere about 30,500. There is more selling pressure which has come in there. And in fact, open interest build-up on the Bank Nifty futures seems to be higher, about up 14%. Just want to pull up the India Volatility Index, which has been hovering in that range of about 11 to 12, which is a comforting sign, mind you. value for the bulls, and at lower levels of volatility, index traders are not expecting any wild moves to come in, at least in the near term. Today's the weekly options expiry day. What range can we expect? In fact, in the morning, if you were to look at the short straddle at the money strike, 11,650 call and put combined premium, the average premium was somewhere about 50 points, which was giving you a range of about 11,600 to about 11,700. That premium now, combined premium, has fallen from 50 to 20 points. So now it looks like expiry can happen from current levels of about 11,625 to about 11,675 on the upside. So watch out for these levels. In terms of stock futures for the day, Mindtree is the one which has touched its fresh 52-week low, and the fall came in on disappointing set of numbers. Remember, the open offer by L&T took place at 980, and the stock has fallen significantly from those levels. If you look at the open interest, maximum open interest on the put side is at 680 strike and 720 calls. So probably that's the near-term range you can watch out for Mindtree for the day. But on the future side, there is heavy amount of shorting which has come in. Last when I checked, the open interest was up over 40% for Mindtree futures. Yes Bank is the other one which is registered fresh lows in today's trade. In fact, options data, if you watch here as well, maximum open interest on the call side is at 110 as well as the 100 strike. But interestingly, the put strike maximum open interest is at 80 and the day low is 79, and from thereabouts the stocks recovered and currently trading around the levels of 86. And of course on the future side as well, we've seen some shorting coming about for Yes Bank. HDFC Limited lending support to Nifty. In fact, the top Nifty contributor, contributing about 25 points. Had it not been for HDFC Twins today, I think index would be trading very close to the 11,600 mark. It's also trading at its life high levels, and if you look at the data closely on NSE, it is indicating almost 70% of the quantity which has been traded so far is marked for delivery, which is a positive sign. On the future side, you are seeing long positions coming about, and the July futures of HDFC are trading at a discount of nearly 20 points.
All right, let's begin with a market voice then. Sanjay Sinha, founder of Citrus Advisors, he's joining us on the show this afternoon. Sanjay, thanks very much for taking out the time, and it's been some time since we've spoken to you. But, you know, how is it that you're gauging the markets to be now? Because it's mainly going to be more earnings driven. For the index, you're not actually seeing much of a move. It was pretty range bound up until a few days ago when we saw that big move taking place. But any disappointments from earnings, you know, is seeing a big backlash from investors.
So therefore, you know, that is not very surprising. See, markets at any point of time are driven by three factors: liquidity, valuations, and events. This month happens to be the month of the quarterly results, and therefore both the events and the valuations are factors which get intertwined in this month. And as you very rightly said, you know, the market did approach the quarterly season with a lot of trepidation, and therefore, given the fact that, you know, the market had already rallied from the levels of almost 11,000 points of Nifty to the levels of almost 12,000 points at the budget, there was very little room for any disappointment. And therefore, in the course of the last 2 weeks, if you have seen within the sector, if there is a result that has met market expectation, the stock price remains flat. If the results have not met expectation, the reaction is extremely adverse. And I think, you know, that is a trend that is going to stay with us for the rest of the result season also, given the fact that, you know, the global factors are also not something which are extremely supportive of a very bullish move as far as the Indian markets are concerned.
So how does one start to build a portfolio or start to reassemble their portfolio, making sure that they have the right balance in place to capitalize on any upcoming move?
So I think, you know, given the expectations of about a double digit and a high double digit earnings growth as far as the Nifty is concerned for FY20, 12,000 points plus minus 500 points of Nifty would be the fulcrum around which the market is likely to revolve. Having said that, I think the focus is now going to move very specifically to stocks. And I think that is going to be there for the next 12 months till the time that, you know, this conviction that the Nifty EPS is going to be in double-digit growth territory for the next couple of years gains a lot of currency. So I believe that we today are passing through a situation in which post the budget there has been again a bipolar behavior of the market, where only a handful of stocks are holding firm and a larger majority of the markets are weak. I think once the flush of the result season is out, one of the factors which is causing uncertainty will be out of the way. Second thing is that in this noise of the markets and the budget and the expectations and the disappointment, one very significant factor is being ignored, which is the very sharp fall in the gilt yields. Now, this fall in the gilt yields actually poses a very positive factor for many of the interest sensitive stocks. So my expectation is that over the next couple of months, we will see the slant of the market moving again in favor of the interest rate sensitives. This can be taken to be a period of consolidation or maybe a period of weakness that can be capitalized on. And therefore, if you have to build your portfolio, 60% weight in favor of the interest rate sensitives and maybe 30 to 40% weight in favor of the defensive will be the one which will pay you good dividends over the next 24 months.
Sanjay, good afternoon. Neeraj here. Would you believe that the time to buy into some of these companies as well, even if you go with this allocation, would be a bit later on? The current spate of results and the commentary from a number of companies seems to suggest that the slowdown of any sorts has only gotten exaggerated, and it'll probably ebb and then come up with a bit of time. Do you reckon that the markets are headed lower and therefore these allocations should also be done with a bit of a lag?
Yeah, so I think as a prudent strategy, that would be the sensible thing to do, given the fact that but right now the negatives surrounding some of the consumption-oriented sectors is very high, and I think that is not very surprising because the monthly numbers which are coming out for auto sales, the Nielsen numbers that came out for the FMCG sector yesterday, all these numbers are actually painting a very dark picture. What can change this scenario could be a couple of things. One is that if this decline in the interest rate scenario also gets supported by an orderly flow of credit for consumption, which I think has been a victim in the post ILFS scenario, I think that will be one big booster for consumption. Second is that monsoon at this point of time has been deficient on an overall basis and has been very, I would say, in terms of its spatial distribution, also has not been very even. So if we, by the end of the monsoon season, if we have a good spatial distribution along with a strong number from the monsoon, I think consumption will be a sector which will get a boost. Now, is that something that is going to happen in a hurry? I don't think so. I think we will probably be past the result season by when we will see clarity on both the orderly flow of credit leading to a better consumption environment and also a good monsoon. So therefore, there is no hurry. One can stagger your investments from this point of time. But as a strategic allocation is where I would feel that a 60% strategic allocation to interest rate sensitives, and this can be staggered and filled up over the next maybe 2 months or so. No hurry.
Okay, Sanjay, we leave it at that note. Appreciate you joining us today and taking us through your views on the markets. Well, the markets continue to trade weak. Nifty still down about 50 points in trade. Let's move on to our next conversation. And CRISIL has put out a note on steel makers bracing for rising iron ore cost. The note expects non-integrated players to see a 300 to 400 basis point decline in EBITDA margin through the next fiscal. Let's discuss this in greater detail with Hetal Gandhi, Director at CRISIL Research. Hi, Hetal. Good afternoon to you. And thanks a lot for joining us today on Bloomberg Quint. Well, we do understand that almost 30 mines will be up for renewal next year, owing to which your report states that there could be scarcity of iron ore in the market. Keeping that hypothesis in mind, how much scarcity do you foresee? And you've already highlighted in your report that margin impact would be about 300 to 400 basis point. But the street is also suggesting that the Odisha miners have already started to increase production to make up for the scarcity which could come up for next year. Your comments on that?
Yeah, so on our base case, we do not think there will be supply disruption. That is a pessimistic scenario where we expect a supply disruption. But we definitely believe that given that these 30 leases are coming up for renewal, you will see merchant miners bidding at premiums. One of the key reasons for that is the kind of difference that exists between the international and the domestic prices. And that would result into almost 35 to 40% premiums at which these mines would be bid. Given this scenario, we can expect that iron ore prices would increase, or the cost for non-integrated players would increase by around 15 to 20%.
So what is your forecast with regard to the iron ore prices for next year?
We are expecting that over the next 2 years, which is until FY21, because the leasing will happen this year, which is FY20, we will expect prices to go up by 15 to 20%. This in turn will result into a higher cost for them. And given that steel prices are on a downward trend, we expect margins to go down by around 350 to 400 basis points over the next 2 years.
Either just for the understanding of our viewers, 30 leases come up for renewal next year. What's the procedure then going ahead? How much time would it take to allocate the new mines?
We expect that the government would not bring about a disruption in the supply side of it, and therefore they would keep these leases more for bidding only for the merchant miners. If we look at Odisha, almost 50% of Odisha's production would go for renewal, and a large proportion of that is being mined by merchant miners. These merchant miners give supply to the entire secondary steel manufacturing, and hence disruption would not be an issue. 6 to 8 months is what it will take for the entire renewal process. However, in our base case, we assume that that will not have an impact on supply, but it will have an impact on bid premiums and prices.
What happens to some of these listed steel players then? What would you do with them? I mean, what would the outlook be for some of the steel manufacturers?
Steel manufacturers, we do not expect any significant increase in prices, and that is because they already have their leasing mines in place. However, steel prices are going down, as a result of which you may see a moderate drop in margins over the next 2 years, around 100 to 150 basis points. There are integrated steel players who have also bought lease licenses over the last 2 years. There, the cost of iron ore is expected to increase by around 5 to 8%, and that will see a drop in margins of up to 200 basis points. And almost 65 to 70% of my steel production is coming from the non-integrated guys, and that production is going to see a sharper drop in margins, which would be close to 400 basis points over 2 years.
I believe in your report you've also suggested variable scenarios, different scenarios with regards to the auctioning, supply disruption and the iron ore price. Could you enumerate some of this for us on the bull case and the bear case, and then what is the implication of that?
What we believe is that there are two possible things. One is that the government says that, let's not go for the bidding process at all, and I'm renewing the licenses for all these merchant miners for the next 3 to 4 years. In such a scenario, you would see that there might be no increase in prices. But we believe that given the kind of gap that exists between the international and the domestic prices, and that gap has only expanded this year because international prices have shot up significantly. We believe that the government would go for the leasing option. We also believe that the merchant miners' profitability is pretty good, and therefore they will bid at premiums. In the worst case scenario, what can happen is that the government decides that they would open up these mines for even the large integrated players. However, there are two bottlenecks to this. One is that if you look at the kind of scenario that exists within Odisha, a large proportion of the iron ore that is being mined is used in and around the state by the secondary steel players for manufacturing. And these merchant miners are also all of them based in and around Odisha. Almost 70% of the production is going through these merchant miners. We believe that the government would not go to actually, disrupt that ecosystem that is present, and therefore that scenario also is a lower possibility scenario. However, if that happens, then the increase in prices can be very sharp because the larger integrated players can bid much aggressively. So you can see almost 35–40% increase in iron ore prices. We believe that that scenario is unlikely to take place.
Okay, Hetal, your report also states that the integrated players, their margins would also be impacted by about 100 bips. Why is that?
So you are steel prices on a downward trend, both internationally as well as domestically. If you look at the segments in which steel is getting consumed, a large proportion would be in construction and infra, followed by auto. Auto, we are seeing a slowdown in terms of the production volumes, and we believe that that will continue in the first half. Second half could be much better. Construction, there are two legs of it, one real estate and another is infra. While infra investments continue to rise, we are seeing private real estate investments being much moderated as compared to the past few years. It's only affordable housing, government-led investments which is contributing to the incremental growth. So we are expecting the demand also to remain moderated around 5.5–6%, which will result in your domestic steel prices to be on a downward trend, impacting margins for the larger guys as well.
All right, Hetal, it was a pleasure chatting with you. Thank you so much for joining in and highlighting that report of yours on what happens with regards to steel players and the implications of increase in iron ore prices. Moving on and getting our discussion going, Rahul Randeria, independent market expert, is joining us on the show right now. Rahul, today's session has been slightly disappointing from the perspective of both the Nifty as well as the Bank Nifty. Up until now, a few weeks back, we had noticed some amount of exhaustion for the Nifty Bank, which has actually started turning around. But I guess today could probably be an aberration, or do you feel that there could be still more downside left for Bank Nifty?
Yeah, good afternoon, Devina. If you look at the last 6 trading sessions, after the budget, we have seen a sharp sell-off in the 2 days, and again in the last 6 trading session after that sell-off, Nifty has hardly managed to retrace at least the 50% of the downfall. So that clearly indicates that there has been a pressure at the higher levels. Now, if we look at the 15 minutes or hourly charts, on intraday basis, last 6 days, the impulse in the Nifty are very slow, and the selling pressure is coming from the higher levels. So definitely there has been a lack of clarity in the trend. But looking at the components of the heavyweight stocks in Bank Nifty as well as the whole Nifty basket, we have seen that the heavyweights which were taking index higher now some sort of losing momentum at the current level. That is the reason why we are seeing the index are not able to sustain at the higher levels. So definitely for at least positionally already we have been bearish on the market since last couple of weeks, and currently also what we see that from current levels Nifty can drift down to the levels of maybe the swing low, which is around 11,460 the couple of days back, which was marked. It will take some time, but yes, definitely in this scenario one should go short at the higher levels. For intraday, I don't think so major downside could be seen because today is a weekly expiry. It could be the premium playing game, the calls and put writers would be active today. So I don't think so major downfall for today. But yes, positionally I feel that Nifty can test the level, the swing low, which is 11,460, and Bank Nifty can test the psychological mark, which is 30,000. So definitely at current levels, those who want to take a call for positional basis, maybe for next 10 to 15 days, can go short at current levels in Nifty with a stop loss of 11,800 on the upside, downside target 11,460, and Bank Nifty one can sell at current levels for the target of 30,000 with a stop loss of 30,850 on the upside.
Okay, what about stocks then, Rahul?
Yeah, I have a sell call in ICICI Bank. One can sell at current levels, which is 420, and on pullbacks with a stop loss of 432. On the downside, I feel the stock can test the levels of 400 in short to medium term. Second sell call is in Siemens, where one can go short at current levels and on pullbacks with a stop loss of 1246 on the upside. Downside, I feel that Siemens can test the levels of 1140.
Okay, those are some ideas coming your way. Those are the technical ideas from Rahul, but it's time to bring in our fundamental guest on the show. Gurmeet Chadha of Complete Circle Consultants is joining us now. Hi Gurmeet, good afternoon to you, and thanks a lot for joining us once again on this show. Gurmeet, first up, a word on the earnings that we've received from the IT pack. Disappointment from Tata Elxsi, Mindtree. We've seen sharp losses in the last 2 trading sessions for both of them. And Wipro, where the top line was below management's guidance itself, but we are seeing some bit of gains coming up. In fact, as we speak, Gurmeet, Wipro is at day's high, sitting with gains of about 5%. Your thoughts on the IT pack right now and the earnings which have come out so far?
So, you're right, Naveed. I think the market is right now, as I said, priced to perfection, and the reaction, so we obviously there are 2-3 factors which drive market. So you have liquidity, and the earning season is on. It's valuation, and obviously the sentiment. I think wherever there is a disappointment, we've seen whether it is the names you just spoke about, whether it was Mindtree or Tata Elxsi, even in banks. I think the reaction is to the extreme. We saw Infosys, for example, management upping the guidance to more 8.5 to 10%, and also some positive commentary on capital allocation going up to 80-85% of the cash flows. Really lifting the stock up. So my sense is it's right now makes sense in an environment like this to stick to the TCS and Infosys. We've seen with the Mindtree results, the wage hike had a big impact because attrition is a serious issue. Their ability to manage FX volatility vis-a-vis the larger ones are I'm not saying they are challenged, but they have lesser expertise there. The deal with momentum with the larger players is pretty high. If you see Infosys numbers in particular, the digital contributed almost 37%. So not only it gives you that momentum, it also gives you some cushion on the margin in an environment like this. So my sense would be that Infosys at 20 times, TCS at about 22 times, they're not very expensive, and they offer you some degree of, I would not say being defensive, but some degree of safety in terms of their track record and visibility of earnings going forward. So stick to the large names here. I think the smaller ones, with an exception of maybe one or two, will find it tough, and you will see margins under pressure.
Okay, well, margins for the entire industry has been under pressure because of higher wages and also rupee appreciation and higher visa costs, and that's been the trend which we've seen for all the IT players. Talking about earnings, ACC will be the first from the cement pack to report earnings today. Remember, volumes took a hit due to lack of government spending in this quarter, and it's likely to have hurt the operational performance as well. Nikki Mirchandani is standing by with what the street is pricing in this time around from ACC. Nikki, over to you.
Thanks, Navneet. We're looking at a flatter sort of quarter for ACC. Top line, we're looking at a 3,845 crore sort of a number, which is almost a similar figure that we saw in the corresponding quarter. On the operational front, we're looking at a slight amount of dip coming in there, 1.5% to 2% downtick. The number that we're working with is around 616 crore, which compares to 620 crore that we've seen in the corresponding quarter. Margins are expected to remain stable around that 16% kind of a level, and profitability of the company is expected to be up as much as 11% to a number of 362 crore. As you just mentioned, volumes are expected to take a hit. We're expecting a downtick of as much as 1.5% to 2% to a number of around 7.1 million ton, which compares to 7.2 to 3 million ton that we saw in the corresponding quarter, mainly on account of three factors: sand mining issue, water shortage, along with that the election demand, the demand lullness that we saw during the election period. That's expected to weigh down on the volume performance of the company. EBITDA per ton performance, however, is expected to be on the flattish note, at least from the Bloomberg estimates. That's on account of the high realization that we're expecting from North, Central and Western region, which form around 60% of ACC's overall volume. But then some sort of another set of brokerages are also working with an estimate of 5% uptick in your unitary performance. That's the EBITDA per ton number, mainly on account of higher realization and the cost optimization measures, which are to be seen in terms of lower pet coke as well as diesel prices. Net, we're expecting a flatter start of quarter coming in from ACC.
All right, that's ACC for you. Remember, last quarter, both Ultratech and ACC were closely watched, and it was Ultratech that saw much of the gains coming in on the back of a heavy volume spike of about 21% that it reported then. Both these counters will be equally watched to give us an idea as to how the trend is progressing within the cement pocket. But moving on, another stock in focus on the back of results is Colgate-Palmolive, and it's trading with gains after its first quarter numbers. Margins saw an expansion while the bottom line was subdued. Agam Vakil is standing by to put things into perspective for us. Agam.
Right, so let me begin with the top line. Well, a lot of analysts out there in the market were focused with respect to top line, especially keeping your volumes in mind. So we do have a 4.2% rise in revenues at around 1,085 crores, and this is just a tad below street expectations. In terms of margins, as you have mentioned, we are looking at an expansion of 70 basis points to around 27.7%, and we have seen profits decline by as much as 10.8%, but the profits are declining on a reported basis is because of the base quarter having an exceptional gain. On an adjusted basis, we have seen growth in the bottom line. Also, in terms of volumes growth, that stands at around 4%. Now, a lot of analysts, again in the markets, were expecting a decline in volumes, though the likes of Kotak Institutional Equities and IDFC were putting in expectations around 4 to 5%. So that, of course, is turned out to be a positive when it comes to consensus. We've seen flat movement as far as gross margins are concerned, and raw material costs have actually come down 1% despite the fact that we've actually seen revenues rise, which means that a ratio of raw materials taken to revenues stands around 28.7% against 30%, indicating softening as far as your input costs are concerned. On the whole, it's been a steady quarter, and at least as far as volumes are concerned, well, if not slightly better, at least in line with street expectations.
All right, Agam, thanks a lot for bringing that review of Colgate, and Street seems to be giving a thumbs up to that for 4% volume growth. Remember, last quarter it was somewhere about 5% and 3.5% higher for Colgate. Gurmeet, I'm just going back to ACC. This year, a lot of market experts have been bullish on this space, and just two outperformers have been there, Ultratech and Shree Cement. Would something like ACC excite you, considering it is trading very close to its replacement cost, and one player too which has almost a pan-India presence?
So you're right, Navneet. I think positive on ACC, and I'm more positive on pan-India players than regional players. I think you will see is probably a flattish quarter as far as the volumes are concerned, but the realizations and EBITDA per ton would be decent. I think largely because of the limited price hikes which they have undertaken, and the cost optimization initiatives, as well as the stable input prices, largely petcoke and others. So my sense is cement looks a good play. Also, if you look at it, I think there is an operating leverage which will play out if you take a slightly long issue, which is 2 to 3 years. I think you will see an uptick in housing, initiated by the government. There are already talks of 1.9 crore homes, which they have a target for this year and next year. So currently, if you take clinker capacity into account, the cement industry is roughly at about 60-65%, and bulk of the surplus capacity additions which we have seen probably to me are behind us. So so if you see, there are top 3 players today who probably will control 70-80% of the market. Take yourself back 6-7 years, and you would have probably top 10 players, controlling about 70% of the market. Ultratech itself alone would be more than 1/3 of the market. So I'll be positive on Ultratech and ACC as a pan-India play, largely on account of operating leverage, improving realizations in terms of and also the fact that the housing focus would eventually lead to some kind of a volume uptake. May not be double digit, but maybe in the range of maybe high single digits.
Okay, got that. That's ACC for you. Watch out for the numbers as they come out later today. Hadrian Mendonca of IIFL is also joining us on the show this afternoon. Hadrian, we were talking to Rahul earlier on, and he was of the opinion that the larger trend in the near term seems to be more negative, and therefore could look at taking short positions for the next 7 to 10 days. Is that something you agree with, or you have a different approach?
Yeah, see, so weakness is definitely visible, and and if you see the heavyweights, more specifically with the banking space, all the heavyweights are actually under pressure. If you leave out the likes of HDFC Bank, and also the Kotak Bank. So these are the 2 stocks that are actually bucking the negative trend currently. But apart from that, if you see ICICI Bank, Axis Bank, other State Bank, even the PSU Bank leader, all these 3 important heavyweights are under pressure. I think that is the main reason why the bearish stance is currently there. As far as the Bank Nifty is concerned, we are slightly bearish on the index currently. We are expecting a short-term target of 30,250 levels, whereas keeping a very strict stop loss of 30,698. Again, the reason is same. The constituent-wise, we are seeing the advanced decline ratio heavily in the favor of the bears currently within the banking space. One more thing, that it is not broken yesterday's high as well. So this means that today, if you do on a day-to-day basis analysis, today's high would be a lower high compared to yesterday, so which means that weakness is definitely visible. So keeping a strict stop loss of 30,698, one can remain short on the Bank Nifty July futures.
All right. What else in terms of stocks, Hadrian? While that's your index call, do you have more of a short bias, or you'll probably trade the long on a few stocks as well?
Yeah, both the stocks that we advise are on the short side. The first stock that we are again bearish on is Cadila Healthcare. The stock has actually failed to surpass its 50-day moving average. Secondly, it has again broken down from a rising channel pattern, which actually confirms a lower top, lower bottom structure for Cadila. No one would want to be long in such a stock, and the right strategy would be sell on rallies. So we saw a rally in the past 1.5 week, and currently it has broken the rising trend. One can consider going short on Cadila July futures. We're expecting a target of 219 with a stop loss of 234 on the upside. The second stock that we are bearish in the near term is the Sun TV July futures. Again, the same scenario for Sun TV as well. Something very similar to what Cadila is doing, a lower top, lower bottom structure, an extension of it that we have observed on the daily charts. I think one can consider going short on Sun TV July futures as well for a target of 452, keeping a stop loss at 476 on the upside.
Okay, so those are some technical bets coming your way. Just want to mark few stocks before we take views on more companies. Pull up Z Entertainment, that's up about 2% right now. And you've also got Britannia, which is surged about 1 to 1.5%. Pull up Dabur as well. I believe the numbers come out for Dabur tomorrow. Ahead of the numbers, let's see what that one is doing. Remember last quarter, they disappointed the street with the volume growth they posted, and the numbers did not look great at all. So Dabur ahead of the numbers is seeing a marginal cut of about 0.6%. Very quickly, Rahul, on the charts, how is this one looking? Ahead of the numbers, would you take a bet here?
I think so. Looking at the last 2 to 3 weeks, and the stock has rallied from the levels of 375, and this has never happened in a very short span of time in the recent past. So definitely I think though that the result might be discounted. At current levels, I would not recommend to go long, because the risk reward is not favorable, and currently the today's high, which is around 435, has been a multiple resistance previously. So definitely I would rather recommend to book profits at current levels. Yes, but looking at the overall setup, if there is a correction or a profit booking in the coming days, I would be ideally buying the stock around the range of 410 to 415. But at current levels, I would recommend to book profits and wait for some sort of correction and then enter at the lower levels.
Actually, I want to look at Spark. The stock has just suddenly shot up in trade. It's now up about 10.5%, and that's the highest point of the day for Spark. Volumes are much higher as well on the counter, and we've been talking about how this stock has been performing on the back of the Sun Pharma upgrade. But just see the last 7 days' performance, including the gains you've seen over the last few days. It's almost 30% plus for Spark right now. Gurmeet, any specific reason why there could be so much of interest in a Spark?
Devina, honestly, haven't tracked it that closely. I think the last I had news was that the orphan drug designation from the US FDA. I don't know if it's really related to that event, but to be honest, it's not been on the radar, not been tracking it.
At least on the charts, Hadrian, would you trade a Spark after a 30% bump up?
Yeah, absolutely. You want to be in a stock that is showing very good momentum, and Spark is one, outstanding, candidate that has actually shown tremendous momentum in the recent past. No doubt on the charts, it has entered into overbought position, but that does not mean we are going to see, any kind of, stoppage in the current momentum. I think one can definitely, continue to hold on to your positions. 162 is the previous May's high, 28th May's high of 162 is what we are observing, and that could act as an important resistance. But post which I think there could be no stopping for Spark. So, continue to hold on to your long positions.
Double upgrade on Sun Pharma has worked wonders for Sun Pharma Advanced Research. And by the way, it did go down one of the days. So I think if you look at this week's chart for Spark, you will see that while it's largely gone up, it's also had one down day, if I'm not wrong. Yeah, there. I think Tuesday was a down day, or Wednesday was a down day, and then it's again resumed its upward move. But 25% this week is not a mean feat. The other one, fundamentally and technically both, but fundamentally first, Gurmeet, Colgate, amidst all those talks of how the numbers might be lower, and that was the widespread rumor on all social media or all market groups. the company surprised positively compared to what the estimates were. Now, my question is, were the results good enough to inspire you to go out and put fresh money to work in Colgate?
See, Neeraj, I mean, if you take a slightly longish view, consumer staples look very, very good for an economy as a whole. I have a little bit of biasness towards Colgate because we have been distributors of Colgate as a family for about almost 3 decades now. So if you see, there are two clear, if you take consumer companies, especially staples, there are two things you have to watch out for. One is the pattern and the premiumization, and second is the velocity of consumption. So what probably we are seeing, obviously the volumes from double digit have come down to 4% in the recent quarter. But if you see and if you compare this example with China, moment you are close to that $2,000 per capita range, in China the consumption of toothpaste and FMCG went up from 1.6 times to 2.6 times in next 5 years when the per capita income went up. So that's the velocity. Right. So I think in consumer staples in India, you will see the pattern and the premiumization play, whether it is HUL, whether it is Colgate, whether it is Dabur. And second, you would see the velocity coming into play. So, but you have to have a 4, 5 year, 6 year outlook on it. And you are never going to get these stocks at 20, 30 Ps. I mean, even if you get that because of some black swan event, that's probably the time to lap it up. So I'll be a buyer in Colgate, but has to be a very long side on the portfolio considering the valuations we are in. And similarly for an HUL and Dabur or Nestle, in that category. So more longish view here would help. But if you want to be a little more, take a more medium-term outlook, which is a more high-risk, high-reward game, probably discretionary and durables and white goods look a better play.
Okay. Let's wait and watch. By the way, I think the Bloomberg Terminal is putting out some news about City Union Bank looking to raise some monies. I think 500 crores, if I'm not wrong, is the number that they put out via QIP, and that's, I reckon, a large sum. If you can get the DES of City Union Bank or just put up the stock price of City Union Bank, I think the stock should be showing a bit of a spike, if I'm not wrong. Well, yeah, no, actually not a bit of a spike as well. The only reason I was wondering was 15,000 crores is the market cap, so 500 crores is less than 5% dilution, so it's not a very large sum of money that they're looking to raise in any fashion whatsoever. Gurmeet, the other question that a lot of people throw up is when it comes to banks is with regards to Axis Bank. Now, bank is looking to raise money. The point is, if we just look at the ratios or the kind of money that it's sitting on, it doesn't necessarily need to at the current point of time on the car basis. Is it readying itself for making some acquisitionary moves which could be leading the bank to do this? And what would be your call on the stock, of course?
So could be Neeraj, happens to be in our top 3 picks as far as the banking and the financial space goes. At about FY20, almost about 2.1, 2.2 book value, so not very, very expensive. I've been speaking to a lot of friends who are at key positions in Axis, who've been ex-colleagues, and I think the focus they have on all metrics, whether it is assets, whether it is CASA mobilization, whether it is fee income, they are building their wealth proposition, getting inspired from HDFC and Kotak, hiring key talent. It gives me a lot of confidence from a medium to long term perspective. Also, if you see in the fresh NPA cycle, which has hit the likes of Yes Bank and others, there are no new names. So there is no Cox and King, there is no or very little exposure to the ADAG and the Syntex and the Cox and Kings and the McLeod of the world. So you will see a gradual improvement across metrics and across operating ratios. And if you see Yes Bank yesterday, what helped them probably, which got unnoticed, was a treasury gain of 450 to 460 crores. In Axis Bank and likes of ICICI Bank, that would be pretty significant, which will add more to the bottom line rather than helping them provision more. So I am very positive on Axis, and you're right at the capital adequacy ratio they are at. Probably this looks more like something, raising money as a both growth and acquisition capital. And it could be Max, could be any tier 2 bank. We'll have to see. We'll have to wait and see.
Gurmeet, before we thank you, a word on Yes Bank. I know I've taken your view on this one in the past as well, and you've Clearly said, though, the valuations could be below one-time book, but stay away. And what the numbers have shown, higher provisions, higher slippages this time around, continues to weigh on the stock price again. And majority of the brokerages have cut down their target price. Your thoughts on the earnings? Is there more pain left for Yes Bank?
Navneet, very tempting at this price, I'll be honest with you, but I would like to watch out one more quarter. I would also like to see the fundraise getting into fructifying, because I want to see how much dilution, because if at 1.2 billion which the management spoke about, and if the first round is of, let's say, 60%, you can't do it with one PE firm. Has to be probably two PE firms as far as the RBI framework is concerned. Second, one thing what concerned me was that their CET1 is now almost hitting the floor, which is 8%, the regulatory floor, which probably would need immediate capital infusion, if you ask me. The slippages were high. In fact, there were some slippages outside the BB and below portfolio. What concerns me most is the real estate portfolio. So because if you look at out of 100 rupees they have there, only 25% around is provided for in that watch list. And they say that the 75% portfolio is doing good and there will be no impairment, which I don't think so the street is digesting. Also, the CASA mobilization has been hit. So I think it's across metrics. I think there was disappointment. Had it not been for the treasury gain of that 450, 460 crores, I think the numbers would have looked even worse. And that's what probably is reflecting in the disappointment in the price. But I agree with you. The price right now looks very, very tempting. You could be a little tactical here, but I would still suggest investors to wait out for the capital raising and the names which come in. So it will be capital raising, and then the second tranche would be through QIP. So wait it out for that. Then possibly even you can enter later also if the stock stabilizes.
All right. We'll leave it at that. Thanks so very much, Gurmeet. Really appreciate you taking out the time this afternoon.
Thanks.
And keeping up with Yes Bank then, Ravneet Gill sees NPA pain waning from here on. Yes Bank's MD and CEO says the exposure to two large financial conglomerates which fell below investment grade is well collateralized, and it's more a liquidity issue than a solvency problem. Ira Dugal started off by asking him if the private lender was late in identifying the pain points. Here's what Gill had to say.
First and foremost, that it's not a starting of a process as far as we are concerned. This quarter represents the peaking of a double B and below book, and from here we just see it going in one direction, which is down. Okay, so we see actually a fairly material contraction in our double B and below book in the upcoming quarters. When you say that the other banks went through situations like these, I think the distinction that you need to make is that for many of them it was a cyclical issue, and the resolution cannot happen till the time that the cycle reverses. For us, I don't think that's really the issue. If you look at our double B and below book, it's not as if it's a very granular book or which is very heavily exposed to a particular sector or a particular industry. This is a handful of concentrated exposures which are facing liquidity issues, not solvency issues. And so the reversal of this could also happen very quickly. So we feel that each of the resolutions, when they happen, and I expect at least two of the larger resolutions to happen this quarter, you will see a fairly big contraction in our double B and below book.
So the problem you're saying is not that you focused on certain sectors like infrastructure, which other banks did, but then maybe the mistake was on certain groups. And I think we do know that there are at least a couple of large groups in your portfolio which at a group level, promoter level, are facing stress. How easy will that be to resolve? So
I think, it's in hindsight, you can always say it was a mistake or, it was poor judgment. But if you see when these exposures were assumed, and the ratings of these counterparties, I mean, they were absolutely fine. I mean, they were all investment grade and in good health. I think what happened was that post-September and what happened with ILFS and then to the NBFC sector, we've seen tightening of credit markets. Refinancing has become tougher, and I think some of these groups have taken the brunt of that. It just so happens that the timing was such that each of them faced this issue with regard to liquidity at the same time, and to that extent, you can start checking in terms of what the underwriting rationale behind this was. I don't quite see it that way. Like I said, it's really a timing issue. But equally, if you see that the underlying assets that these companies have, those are very, very good. And the resolution here does not need to happen in terms of reversal of fortunes of the company per se. which could be a medium long-term event. Here, the resolution could happen on the back of asset monetization. It could happen on the basis of a stake sale. It could happen in terms of a change of control or ownership. And I think that's what's effectively happening in many of these names. And so to that extent, I don't think this recovery process should be so protracted.
Okay. So the focus now is on the BB and below book, which is about 9% right now?
That's right.
Okay. And you would see it come down to what over what period of time?
Significantly, because if you see the composition of the BB and below book, it actually has very few names. And so each of the names which comes out of it on the back of resolution will actually bring it down significantly. So over the next few quarters, I actually see this book contract very, very significantly.
Okay, but the stress didn't only come from the BB and below, right? I think a couple of these names that we're talking about, these two financial services, would have been in the A category. No, and the A rated is at 41% of your book.
No, so I think, let me just draw that distinction for you. As far as the growth in the BB and below book from 23 to 29,000 crores comes effectively on the back of two names. And these are two large financial services companies. Here we don't have loans, we have bonds. Or NCDs. So these in any case get a mark to market. So even if you go back to the last quarter and you look at a treasury line, you will see the mark to market on that. So it's not as if these were names which were not known or which have suddenly cropped up. It's just that the level of the mark to market has gone up based on the rating downgrades that these names may have potentially suffered. But the entire slippage for the quarter, if you see, comes from the BB and below book. Okay. Now, the question is that not all of it comes from the watch list that we put out. The reason for putting out a watch list in the last quarter was very, very clear. We were going to be approaching investors for equity, and we looked at names where there were imminent repayments, where we thought that the cash flows could not support those, and we thought it was only right, it was prudent to be able to go out there transparently tell investors that these names could slip. Now, the fact is that the subsequent slippages that may have happened did not only happen from the watch list, but happened from the BB and below book, and at the end of the day the watch list was derived from the BB and below book. So I thought we've got that ring fenced in terms of which were the names where we could potentially face stress. And as far as these two financial services names are concerned, yes, I mean the mark to market on those has gone up based on the rating downgrades.
Okay. No, so sorry, correct me if I'm wrong here. So these two names would not have been BB and below last quarter, right? In the March quarter, they weren't.
They weren't.
They were not.
They were not, but they had. Yeah. But even though they were investment grade, they had already taken some rating downgrades, and the mark to market for these names was reflecting in our treasury income even last year, even last quarter.
Okay. No, the reason I'm asking that is that one is wondering that from even the A pool, which is very large, which is about 40% of the book, is there an assessment being made by the management that what from that pool has the potential to fall either below investment grade and potentially to a slippage point?
So when we talk about the asset portfolio of Yes Bank, I think one of the things that comes up is the real estate book that we have, which is roughly about 24,000 crores. If you look at the 24,000 crores, 25% of that is fully captured either in the BB and below book or in terms of the NPAs that we have. On the balance 75%, the slippages are absolutely minimal. When I say minimal, they're very small. And then if I look at my overall investment grade corporate book, my SMA2 on the entire thing is about 404 crores. So given how large the asset book is for Yes Bank, and then you look at a number of 404 crores, I think it's really a very, very small marginal number.
And SMA1?
And I think it gives you, SMA1 is more dynamic, so it's more harder to tell, but SMA2, which could potentially point towards potential slippages or incipient weakness, that part is fully captured.